Today we're going to be looking at federal income tax. So the first part we're going to look at is adjusted gross income and taxable income. So withholding tax, employers deduct money for federal income tax. From a worker's pay. The amount withheld are estimates of the tax owed at the end of the year. It's not the actual amount, but it's the estimated amount. So at the end of the year, you could owe more in taxes, or you could have paid too much so you would get more money back. Tax year ends on December 31st. Every year. And you must calculate and pay any federal income tax by tax date, which is April 15th. Gross income is the total income in a year and includes income from wages, salaries, commissions, bonuses, tips, interest, dividends, prizes, pensions, the sale of a stock, and profit from a business. Adjusted gross income. This can be subtracted from your gross income. These include businesses' losses, payments to retirement plans, alimony, and other certain penalties. So your adjusted gross income is your gross income subtracted by any adjustments. Deductions. Deductions reduce the amount of your taxable income. You may deduct interest paid on a mortgage, property taxes, state and income taxes, medical, and dental expenses, casualty and theft losses, and contributions to charities. So, if you went to the hospital and you had medical bills, you can subtract this from your gross income. So you're not taxed on that amount. Standard deductions, they are claimed fixed amount. So you can take the standard deduction, or if the amount that you are able to deduct is larger than the standard, then you can take that amount. Exemptions. Exemptions is the amount of income per person that is free from tax. You may claim one exemption for yourself unless you are claimed as a dependent on another person's tax return. So if your parents claim you, then you cannot claim yourself. They take that exemption. Taxable income is the income that you actually pay taxes on. This is after all of the deductions and exemptions. Are all deducted. So the formula for taxable income is you take your adjusted gross income and you subtract out your deductions and your exemptions. So the standard deduction for an individual is going to be $4,700. Their standard deduction for a married person is $7,800. And lastly, the standard exemption is $3,000, and this is per person. So let's look at some examples. Clara is single and has a gross income of $32,600. She pays $2,600 into an approved retirement plan. She has deductions of $6,900 and one exemption for herself. We need to find her taxable income. So we are always going to start off with our gross income, $32,600. Then we're going to look at any adjustments. So money paid into anything that's been approved. So we had an approved retirement plan of $2,600. So our adjustments, we can subtract from our gross income. So when we subtract this out, we get $30,000. Now she has a deduction of $6,900. And any deductions, we subtract out also. So when we subtract this out, we get $23,100. Then we look at exemptions, and she has one exemption. Remember, exemption is $3,000 per person. So exemptions, we also subtract out. So when we subtract this out, we get $20,100. And that is the taxable income. Let's look at another example. Andy and his spouse has a gross income of $33,000. They file jointly. They make payments into an approved retirement plan of $3,000. Their itemized deductions were only $4,300. So they would take the standard deduction of $7,800. They claim two exemptions. We need to find the taxable income. So again, let's start off with our gross income. So our gross income is $33,000. So we need to take out any adjustments. So they paid into a retirement plan of $3,000. So we can subtract that out. Then they have itemized deductions of $4,300. The standard deductions from our chart above for a married person is $7,800. So since they only had itemized deductions that were smaller, we want to take the larger number. So we can take the standard deduction. The standard deduction is $7,800. So we're going to subtract that. And when we subtract that, we get $22,200. Then we want to take out any exemptions. We had 2 exemptions. And remember, an exemption is per person. So one exemption is $3,000, but we have 2 people. So we're going to have $6,000 for exemptions. So we're going to subtract that out. So we get a total of $16,200. So this total here is the taxable income. Okay, now let's look at income tax due. So employers withhold money for income tax from employee paychecks during the year. The amount of tax paid in withholding is an estimate, so it's probably more or less than the tax that an employee actually owes. So to find the tax due, you must complete a tax return. This is going to tell you how much you owe. If too much withholding tax has been paid, the government will refund any extra money that you paid. So they'll give you back that difference. If too little tax has been paid, so your employer did not take enough money out, then you must pay the difference. So you must pay the government back. So let's look at a federal income tax table. So when you look at this table, you have to determine your filing status first. And your filing status is if you're single, if you're married, or if you're in the head of the household. Then you have to find your taxable income on the chart. Once you find your taxable income, depending on which your filing status is, you're going to take that tax rate. So if you have a taxable income of $90,000 and you're single, you're looking at single, find in between where $90,000 is, which is in between this interval here. So you're going to have a 24% tax rate on your income. So when we do the math, we take the tax rate and we have to change it to a decimal. And then multiply it by our taxable income, and that gives us the amount of income tax. So let's look at a couple examples. Bree is single and has a taxable income of $13,200, and her employer deducts $2,340 in withholding taxes for the year. We need to find Bree's tax due and any refund or owed amount. So we're going to have to refer back to those tax tables. So the first thing we have to do is figure out what she's filing as. So she's single and has a taxable income of $13,200. So let's go back to our chart. She's single and has a taxable income of $13,200. So that's in between this interval. So she has a 12% tax rate. So her tax rate is 12%. We have to take 12% and change it to a decimal. So that's 0.12. And multiply it by our taxable income. And when we multiply that, we get $1,584 as income tax. So now we need to compare. Income tax, we're going to compare. So our income tax, we said and figured out was $1,584. Our withholding, what our employer withheld, was $2,340. So we owe $1,584, but our employer took out more money than what was needed. So since our income tax is smaller, we get a refund. So we're going to subtract the two amounts to see how much back we are going to get. We're going to get $757 back from the government in a refund. Okay, let's look at the last example. Vince Smith is married and files jointly. He and his wife have a taxable income of $23,425 last year. The amount withheld from their wages was $3,384. We need to find the tax due and if it's going to be a refund or if he's going to owe more. So, they're married and filing jointly, and the taxable income of $23,425. So we go back to our chart, and we're going to be using this column here, and the $23,425 is in between this interval, so it's going to be a 12% tax rate. So we're going to take our 12% tax rate, change it to a decimal, multiply it by our income tax. And when we multiply this together, we get income tax of $2,811. Now we're going to compare the two. Our income tax and our withholding tax. So our income tax we calculated to be $2,811. Our withholding tax is $3,384. So we're going to receive a refund, but we need to know how much. So subtract the two amounts. When we subtract the two amounts, we get $573, and that is going to be in the form of a refund from the government. So that is the lesson on federal income tax. Please reach out if you have any questions.